You've raised several issues, the quality of loans, the digitization and the ability to do better due diligence, and cost of money. So let me come to the cost of money. If I take a vote, I mean, I don't know how many people here are below 40. I don't think any of them will have an FD. The migration away from FD is done. Do you think this is a structural shift in the cost of money?
Actually, Lata, when it comes to the preference for an asset class, it is getting guided by the perceived notion in terms of the
return.
That's right. So that is something which is a reality. Having said that, I must also mention that we have done some analysis in the bank, and we could see that almost about 57% of the deposit is there from about 20% of the deposit come from less than 40 years of age bracket, fixed deposit. 20%. And 37% comes from 40 to 60% of the age bracket.
Oh.
So it is 57% of the deposit is still being contributed by people up to the age group of 60.
People who have not retired.
Yeah, people who have not retired. So they are still active. So I think it is more of an asset allocation. People do opt for various kind of instruments depending upon their yield preference and also their risk perception. So it's essentially a risk-return trade-off which people really resort to. And normally it happens that when the markets do so well, at times people don't get to see the risk which are inherent in the markets. Yes. But yes, if at all you will look at it over a long term, these are the aberration which happens at a point of time, but it all gets adjusted with the passage of time.
Okay. No, I agree. The very fact that people are comparing mutual funds and FD is a mistake. I hope those who are doing the comparison are also recognizing the fact that you're getting steady returns in mutual funds over the last 4 years. Yeah. But, there was also a 2019 and 20 when we did not get those returns.
That's why asset allocation principle holds good. Something in the fixed income, something in coupons, something with the market-related return. That actually helps in broad basing the risk-return profile also, and also improve the earnings on the savings.
But to come back to the position of banks, you also gave, I think, over 3.5 margins once. You gave even 3.6 in one quarter. And now, of course, it's 3.35, the last quarter that you gave. Do you think the best of margins is behind you? I mean, look, I think HDFC Bank is 8.2 or 8.1 for a category of, FD. And I think today I saw somebody else giving 7.9, one of the PSU banks, I mean, giving 7.9. So, is it a problem that is going to persist for a year, or do you think it's structural that banks are stuck with higher deposit costs?
No, actually, we have done some analysis which is actually based on the RBI report, where we have done some analysis over a time period, and we could get to see that generally the deposit advances divergence, it persists for anything from 25 months to 41 months. So our assessment is that maybe this divergence perhaps would last somewhere in the June to October quarter.
Okay.
So what you mentioned in terms of the ability to sustain the NIMs, well, I think when it comes to deposit interest rate, of course, different banks, depending upon their ALM situations and also their credit deposit situation, they will have the compulsion of raising deposit at a higher cost also. But much of it will depend upon their asset liability composition and also their credit deposit ratios. So if at all they have got the flexibility in terms of their credit deposit ratio to defer the increase in the interest rate, perhaps their ability to support the NIM would be much higher. And if at all, and also with the lower credit deposit ratio, they can actually decide the portfolio relating to the credit portfolio as well. They can actually look at...
You mean pass on the cost?
Pass on the cost and also look at the higher yielding assets also.
That is, I was waiting for you to say that you will pass on the cost. Now, let us look at the people who are going to take that higher cost.
No, actually, not really passing on the cost, because why I'm saying that passing on the cost, because, see, eventually, if at all you are looking at the best quality assets, your ability to pass on the cost is also limited. So this is something which has to be kept in mind. So essentially, it's a very fine balancing which is required to be done by a banker. One, of course, they cannot trade off in terms of the quality. And if at all they cannot trade off in terms of quality, they have to look at the very fine pricing. And how should they really arrive at that is something which is a skill.
Yes, of course, that's the banker's skill. But are you worried about asset quality? The Reserve Bank Deputy Governor was there, your former colleague at the CNBC-TV18 function, and he said that there isn't anything worrisome about asset quality. But nevertheless, risk weights were raised. And there are NBFCs who tell us that at this point in time, 10% of the total NBFC borrowers have 10 lines of credit. I mean, the over-leverage of a small section maybe. I mean, obviously the other 90% he himself must be saying is, properly leveraged. But are we in a state of over-leverage in retail? Not in corporate. Corporate is absolutely unleveraged, deleveraged.
In fact, that is perhaps the reason maybe RBI had the visibility of such kind of a behavior, and that is one of the reasons why perhaps they increase the RWAs. So naturally, by increasing the RWAs, the cost of fund for such entities have gone up. So this is the other way of discouraging such entities to go for the unsecured in an unbridled manner. So that is, I think, it is coming out of that. So I would say that RBI action was well in time and much ahead of the curve, and probably it was an adequate signal to the system that better as you strengthen your underwriting practices. So I think that is the role of the regulator, and they have performed it very well.
I agree with you that it was, they smelt the rat earlier than
True.
The industry itself perhaps.
Yeah.
But sir, is there still, let me persist with this just for a little bit more. MFIs we already know are in trouble, and we saw that in the first quarter numbers of many of the smaller microfinance companies. Even in retail, it's a very crowded trade. Nobody else is borrowing. Corporates are seriously deleveraged. They are managing their capex with internal accruals, and market rates have gone down because of bond inclusion and US interest rates about to go down. When have we last seen the 10-year under 7%? So, CPs are available for companies at fine rates. ECBs are available because of global, Eurobond rates. So, banks are left with what? The overcrowded retail rate. Everybody is there. P2P lenders se leke SBI tak. The whole range is only crowding on retail. So, are you worried that this overcrowded trade is leading to poorer quality of borrowers getting
No,
loans?
again, here again I would say that when it comes to if at all you are looking for a quality borrower, even in the retail segment, you have to be very mindful in terms of the risk, price which you will charge. If at all, we have seen the huge variety in terms of the retail lending also, and we have seen that there are entities where even the gross NPAs are much less than 1. And there are entities where the gross NPAs are quite high too. So depending upon the choice of customer whom they have picked up, and naturally, when the cost of credit is on the higher side, their ability to, they are trying to have part of the cost recovered through such borrowers. But yes, of course, I think the very important underwriting principle in case of retail borrowing is also to look at the EMI to NMI ratios and also the asset creation which happens. So unless those are the cardinal principles of lending which should not be compromised. And if at all people are in a position to stick to those underwriting principles, I think they are in a position to maintain the quality and also the earnings.
Okay, I'll revisit this in a different avatar just for a wee bit, but I want to come to this whole buzz on digitalization. We've done excellently well when it comes to payment. No country ahead of us. We are second to none. Now, let's come to ULI, the Unified Lending Interface. How close are we, sir?
No, I think as a bank, we had started going for the digital lending, particularly in the SME and the agri space. And that was essentially, we were trying to leverage the ecosystem where the land records are all digitized, where when it comes to GST invoices, we were in a position to have an access to the GST invoices, etc. So we came out with the business rule engine, which was 5 lakh to 5 crore. that kind of a lending, and the intention was essentially we were riding on the success of the threats. But you know, there's a slight difference when it comes to threats. There is a product is already made available to the customer, and they have accepted the bill. So the quality of the product, the payment assurance is very much in place. It is only we were trying to cover the time gap. But when it comes to ULI, which will essentially be, it will be a mechanized way of lending. But to my mind, the basic appraisal is not probably dispensed with. So after the basic appraisal, probably dispensing the credit becomes easier, and also for dispensing the credit, ULI will actually consume the data from the ecosystem, and will be in a position to create algorithms, which will be in a position to guide the decision makers, that whether they should go ahead or not. So I think, to my mind, it has addressed the timely delivery of the credit to a greater extent, but just small bit of appraisal in terms of the credibility of the borrower, etc., which should not be a very difficult task considering the kind of information which is available in the ecosystem. That will probably strengthen the underwriting practices. So I think it should not be a very difficult task. We have already seen that when we were doing actually KCC loans up to 1.60 lakh with the help of the
in Uttar Pradesh. Where was the pilot? It was a pilot, wasn't it?
Uttar Pradesh was done. So we have seen that it happens in virtually in few clicks with nanoseconds. It happens. So it's a reality. It can happen. But yes, of course, as I mentioned, the digital land records becomes one of the very critical component, and also availability of the GST invoices, etc., will be very, very critical. And some bit of an information relating to the borrower in term from the purchaser, etc. Those are the kind of, from the ecosystem we'll have to pick up that information. So it becomes a very, very strong underwriting practice, and particularly for the low value loans, perhaps the cost of administering credit will also come down significantly.
Okay.
That is also there.
No, I'm worried about another kind of cost. You know, are we right in even selling ULI like UPI? In UPI, I have the money in my account and I'm paying somebody. In ULI, you are trusting someone. You have to measure the risk of the person.
Yeah, that's what I said.
Can we sell it as instantaneous?
No,
Isn't it dangerous to do that?
No, it is actually, if I may say so, it is when it comes to commoditization in case of UPI. UPI was merely transaction.
Exactly.
But it is something little beyond in terms of assessing the credit risk. And that's why I said that there is a lot of information which is available in the ecosystem, but perhaps it has to be put to a good use so that the algorithms can be created and decision can become very foolish.
No, my push is, should not bankers be saying, I will not give a nanosecond loan. My job is to assess the risk. I don't want to do it in nanoseconds.
No,
you should resist it, I thought.
I think as far as assessment of risk is concerned, banks will not probably compromise on that.
Okay.
That's what
I agree. Credit card is a loan, which is given literally in nanoseconds. But the whole system cannot be a credit card loan.
No, that is true. That is true.
So you are hoping that banks will...
no, I think that the basic due
the
diligence...
zeal for ULI should not be more than the zeal for due diligence.
Basic due diligence will not be compromised. That's what my sense is.
Okay.
And even when we did the BRE model, we also never compromise on the basic due diligence.
Okay, that's good to hear, sir.
Yeah.
Now let me come to an altogether different chapter. Public sector banks. I mean, you have headed one and, completed your career with Elan. But repeatedly, the government has said, we don't need 65% of the banking sector to be owned by the state. And after that, all those arguments over the first 8 years of this government's term, the arguments have practically stopped. We heard nothing in the current budget, perhaps not even in the previous. You think that this is an agenda which needs to be mooted, that some more privatization is needed?
I'm a believer of ownership agnostic structures. Whether it is private sector or public sector, when it comes to even entities like State Bank of India, where the Government of India ownership is to the tune of 56.92%. But if somebody asks me whether it impacts the decision making, perhaps no. So because it's a board-run entity, and being a board-run entity, it's a responsibility of the board to ensure that the policies are the one which are for the ultimate interest of all the stakeholders. See, when I'm talking of 56.92% held by Government of India, about 43% is held by various other stakeholders, and out of those other stakeholders, 12% is held by the foreign institutional investors also. So we are accountable to all the stakeholders in terms of the value creation. And that is one of the reasons why I feel that either it is private sector or public sector, more important is that the entity should be very focused. And we have also seen the situation where the accidents have happened in the private sector.
Okay, let me put it this way. I read the Banking Companies Act some time back, so I will not be able to quote section and chapter. But the Banking Companies Act, Takeover of Banking Undertakings Act, does give the government, there are chapters and sections in it which give the government the right to impose their policies, their programs. For instance, Mudra or Jandan. It can be imposed on the public sector banks. The Act gives the right, which it cannot impose on banks they don't own. That's one. The second one, you will be bound by the CVC, the CAG, because the law of the land is that if you are a government entity owned more than 51%, all the 3 Cs will be part of the working of the banking system. And then there is the Prevention of Corruption Act. Again, a very unfair act, because commercial decisions are not right or wrong. They are commercial judgment. Now, they do impede a banker who is circumscribed. So I would think there is a very strong argument. Yes, government needs, it has an SBI to impose its, to run its programs, and SBI ran Jandan brilliantly. But do you need 65% of the banking system to be curbed by CVCs? And surely some more space needs to be given to these banking entities.
Well, there are two dimensions to the question which you have raised. The first dimension is to support the social banking program. Social banking program, government can always run through the public sector and private sector both. Because today, when it comes to social banking,
you definitely opened way more Jandan accounts than HDFC or ICICI.
See, the point
I mean,
is that
multiple times.
No, when we opened, probably people did not see the merit. But today, people can see the merit. Those are the accounts where today the average balance has gone to 4,000 rupees. So when we opened those accounts, it was perceived to be a cost. But we have already seen that about 4,000 rupees is a balance which is there in those accounts. And that is one of the reasons why today, when it comes to the private sector banks also, they are equally willing to open such accounts. That is one. Secondly, when it comes to the SME loans or the Mudra loans, or for that matter, the CGFMU loans, we have seen that during the COVID, there was an equal interest from the private sector banks also. So I think it's more of an opportunity which is being perceived by the private sector banks, though the government has got they can certainly do some kind of they may not be in a position to impose, but at the same time, they can have some kind of suasion, moral suasion on them. So that is something which
moral suasion is perfectly understandable.
Yeah, moral suasion is something which you are seeing, and practically, when it comes to the Swanidhi also, there was an active participation from the private sector banks. So we have seen it that I think over the period of time, the general perception that the social banking is not commercially viable probably is not the right thing to say. The second question which you said about the
administrative 3 Cs.
Yeah, 3 Cs. So when it comes to, even when it comes to the private sector banks also, one of the Cs can always chase them, irrespective of the ownership structure. So I think it does not really make much of a difference to my mind, but nevertheless, it would be preference and also the policy preference of the government, which perhaps will decide the future ownership structures.
Fair enough. I agree with you that poor performance has been, found in all kinds of banks, outright bad performance has also been the lot of private sector banks. Now, let me look at a big piece of infrastructure, something we discussed before we came up. The funding of infrastructure now can happen through private money because we have a large insurance and pension fund kitty, 115 lakh crore today, and total deposits is 200 lakh crore, 210 lakh crore. So, the long-term money is almost, and it's growing at 20%. Bank deposits are growing at 11%. So, the gap will be bridged. Yet, that money is not coming to infrastructure, or only 9% is in infrastructure because they are clearly worried that the money may not be available when it is needed. The pensioner cannot be told, that I can't pay the money, I can't return the money to you. They stick to AA+. How do you think this can be bridged? We have the money, but it is not going to where it is needed, which is infrastructure.
Yeah, when it comes to perhaps the way forward would be the developed debt market in the country. And because as of now, when it comes to the certainty of the principal, which is very, very critical for the insurance sector as well as for the pension sector, though there are, when it comes to, the pension sector also, now they have started permitting some investment into the equity and also some investment into the debt securities also. But yes, of course, perhaps some kind of a credit enhancement so that, when it comes to the chase for the AAA or the AA, that can become easier. So credit enhancement can perhaps be the way forward, which will probably facilitate such kind of money flowing into the infrastructure sector. Having said that, I must also mention that when it comes to infrastructure sector, we have already seen that the early success of the InvIT structures. So InvIT structure is the one where at least where the cash flow positive, whichever projects are now cash flow positive, they can be actually taken to the InvIT structure, and out of that the money can be recycled.
Yes.
So that is one option which perhaps can be used in the intervening. And eventually, of course, the development of the debt market, maybe with the help of the credit enhancement, will also probably support the lending support, will support the infrastructure financing.
I'm not very sure, but from what one infrastructure guy told me, InvITs are being purchased by Canadian pension funds, but Indian funds are still not buying InvITs. I could be wrong, but this was what he said, that they have not made the leap, the Indian insurance companies.
No, actually it so happened that when it comes to the pension money from across the globe, they were looking at the kind of returns which are sustainable over a period of time. And to that extent, the infrastructure which is being created in the country offers a decent opportunity. So it's not merely Canadian pension funds, but even the other pension funds across the globe also were showing a lot of interest, and some of the sovereign wealth funds also have shown interest. I think, to my mind, they were having a flavor from the different markets across the globe, and perhaps they had a significantly higher comfort. But now, of course, we are seeing the infrastructure within the country also now in a position to really ride on this opportunity.
Okay. Yeah, let's hope that we are going to see more of this. Now, my final set of questions to you, I don't know if there are people in the audience who want to ask you. My final three questions to you is, what is your ask from the regulator? Now that the pen is down, you can boldly ask, where should they change? The first is the PCR, the LCR. Liquidity coverage, new ratios, do you think you need more time? Now it is not I need time, the system, or provisioning for infrastructure projects, project financing. What is your ask from the regulator on anything?
Well, when it comes to the liquidity coverage ratio, I think the system already has got the cash reserve ratio. And also when it comes to the runoff factors, maybe they probably need to be revisited in the context of the Indian scenario. Because
So do you want them to reduce the ratios or give more time to reach the higher ratio?
No, I think perhaps it can be reduced also because as far as the Indian banking system is concerned, the concentration is not perhaps as high as it is seen in one of such cases, which was Silicon Valley Bank, where on the asset side as well as liability side, both sides there was a concentration. So that is one of the reasons why perhaps and that to my mind is one of the reasons why perhaps when it comes to the digital accounts, the runoff factor has been significantly enhanced. So I think maybe that can be revisited. That is what my sense is. And when it comes to the infrastructure related project financing and also the provisioning requirement, perhaps this can be more rationalized. That's what my sense is.
5% is too much?
No, actually it has to be seen in the context of the LGD in such cases, loss giving ratios in such cases. And if at all it is looked into in the context of the LGD, then perhaps it will be more scientific. That is something which I believe will eventually go a long way in terms of strengthening the system.
Okay. Well, I apologize for using those abbreviations. The Reserve Bank's recent rule is, I mean, it's still a draft rule. If you have too much of what they call unstable deposits, after all, we are all paying in UPI. So for the unstable deposits, you have to keep liquid. The banks have to keep liquid cash to the extent of 15%. At the moment, they keep 10%. They have to keep 15% of those deposits in cash, which is not really cash. You keep it in T-bills, near cash instruments. That ratio has been raised, which is what we meant by raising of the LCR, liquidity coverage ratio. And you heard Mr. Khara's eloquent arguments on why it can be reduced or extended. A final question, where do we see you, Mr. Khara? What is the next avatar?
I should be around.
Okay, so the government has approached you. That's very clear in that case. I think there would be questions. Yeah, you want to complete. Where do we see you? Do we see you in Delhi or Mumbai?
Maybe both the locations.
Okay. Yes, of course. We will be delighted. But anyway, Mr. Ajay Seth is coming later on in the day. We will probably get to know where we see Mr. Khara. Questions from the House? Yes, sir, please. If you can introduce yourself. My mic is available. Oh, it was not supposed to be for the House? It's okay.
Hi, my name is Vishal Sanghvi. I am a serial innovator and researcher, and there are so many new areas investment required. I want to know, like SBI has a lot of branch overseas. And normally they focus on NRI deposit, but how you can make a new avatar, can merge with the investor in India, because there are a lot of our high net worth in US. Earlier it was service class, but after automation rise, there is a more era coming for the new entrepreneurship actually. So how this, this SBI
So
branch...
what you're saying in how will they tap NRI money to finance NRI investors, innovators? Is that what you're saying?
There are new ventures of money is possible too, not only for deposit actually. You know, how you can see, because I cannot see, but you must be see the opportunity as a SBI branches to just getting those funding, not just FD, but people just want to investment,
Tap
not for
global
the
money.
money, but a part of the India's growth story of Viksit Bharat. That's.
In fact, about a year and a half back, we started startup branches. And those startup branches, we had set up about 5 startup branches across the country. And the intention of offering the startup branches was to ensure that we offer the solutions under one roof. And those startups, if at all they have to channelize money overseas, we should be in a position to help them channelizing that money as well. So this is something which we did. And when it comes to our overseas outfits are concerned, we are actually quite niche player in the overseas market, depending upon the opportunities which are available in those respective geographies. We do channelize NRI money, but not from all the pockets. So, but yes, of course, that money is eventually for the support of the economic activity in the country. And so again, it's a very varied model which we pursue in the overseas market.
I am K.K. Gupta from Researcher India. Sir, My point is the bank is losing huge money under the resolution IBC Act, IBC code you can say, for settlement of the accounts. Have any view on that? When you are settling the account under IBC, the resolution is there. So I think huge sacrifice being done by the bankers.
No, actually speaking, when it comes to the sacrifice, certainly looks to be much magnified, because what happens is that when we file the case on the, actually we stop applying interest for quite some time as soon as it becomes NPA. But when we file the case, we file the case with the interest which is applicable till the date. So for all purposes, of course it's not a very prudent way of looking at it, but nevertheless, when we file the case, we ensure that we have 100% provision held against such assets. So now we have to see it in the context that when it comes to supporting such assets, what is the credit cost which we are required to incur? And as against that, when it comes to IBC, how we can have it resolved at the earliest possible. Well, I think there are different experiences across the globe, but knowing by what the IBC has been in a position to generate till now, I would say that the success of the IBC is actually the function of what the market is. When the steel was doing very well, steel assets could fetch much better resolution percentage. Similarly, when power sector started doing well, the power plants have started fetching much better value. But yes, of course, when it comes to EPC, etc., where there's hardly any tangible asset underlying, so there we have seen the challenge. So I think the experience perhaps cannot be put under one category itself. Different assets, we have seen different experiences. But yes, of course, if at all we will aggregate everything, perhaps because that was a point of time when lot many EPC entities went through the IBC process, the overall number looks low. But if at all we will do some granular analysis, we will get to see much better realization also.
I'm told that we are out of time, sir. But you are an old friend, so you can carry on over coffee after...
I would say that leveraging analytics in a big way is going to be a game changer for the industry.
I think that will call for a discussion in its own right, how artificial intelligence is going to be harnessed. But a round of applause for someone who has contributed immensely to the banking system. We have his word. He's going to be available in Bombay and in Delhi. So questions can be fired in future occasions. All the very best, Mr. Khara. Thank you.
Thank you for that extremely intriguing discussion. I request you to please step ahead for a photograph, both of you. Thank you, sir. Thank you, ma'am. Ladies and gentlemen, a quick changeover, and we will be ready to begin the next session, which is on FDI inflows, the big Indian opportunity. And let me tell you one more time that we will be having the whole-time member, Securities and Exchange Board of India, Shri Ananta Narayan Gopalakrishnan, for a special address in this very session, and the valedictory will be saying Shri Ajay Seth, Secretary, Department of Economic Affairs, Ministry of Finance, Government of India. So that will be the last session, and in between these two sessions, we have a session titled, Is the Agricultural Sector Out of the Shackles of Traditional Sahukars?
तू जानता है इसका बैंक कौन है? कौन है? SBI. SBI देता है बिजनेस करंट अकाउंट के साथ POS और QR कोड. इसे कहते हैं सॉलिड बैंक या सॉलिड बैंकिंग.
We've come a long way to get to where we are today. From what started as a single dream to enabling millions of dreams. From a handful of experts to thousands in our team. From two-wheeler to becoming a financing leader, we cover the length and breadth of our nation. As India moves forward, we move forward. With resilience, resolve and determination. With a focus on digital and innovation. We are relentless in our drive as we strive to meet and exceed the evolving needs of being Bharat Ka digital lender. In a market filled with increasing choice, we needed to find our unique brand voice. As part of our journey to tell our growth story, we spoke to people across the country, covering all our stakeholders from customers, channel partners and employees. We sought inspiration in their values and aspirations. We breathe new life in our brand
Okay,
identity.
we are set and ready to begin the next session. I request all those who have moved away from their seats to please return back. Request everyone to return to their seats. We are beginning immediately. So this, ladies and gentlemen, is a session on FDI inflows, the big Indian opportunity. So the foreign direct investment is a key driver of economic growth, bringing in much needed capital, technology and expertise. This session will explore the dynamics of FDI it would offer perspectives from a waiting set of panelists to discuss the roadmap to further enhance India's attractiveness as a global investment destination and ensure its Sri Ananta Narayanan Gopalakrishnan, whole-time member, Securities and Exchange Board of India. Could I request you, sir, to please take your seat on the dais? I also request the session chair, Mr. Janardhanan Ramanujalu, Vice President, Regional Head, Rest of Asia, SEBIC, and the panel speakers, Mr. Imad N. Fakuri, Regional Director, South Asia, International Finance Corporation, the IFC. Welcome, sir. Mr. N. Venkataram, Country Chair, CDPQ India. A very warm welcome to you, sir. And Madam Neetu Samra, CFO, Noida International Airport. A very warm welcome to you, ma'am. All right, so all those standing, one last request, please take your seats. Thank you for your cooperation. We are all set to begin, and without spending any more time, let me call upon for the special address, Sri Ananta Narayan Gopalakrishnan, whole-time member, SEBI, the Securities and Exchange Board of India. Sir.
Thank you so much. At the outset, I wanted to thank CII, dignitaries on the dais, for giving me this opportunity. I'm going to start with a statutory warning. I'm changing the topic for myself. I'm not going to speak about FDI and the future of FDI. Given that I'm coming from the Securities Exchange Board of India, I'm changing the topic to FPI, which falls within my realm, which is foreign portfolio inflows instead. You'll hear a much more informed discussion about FDI from the panelists here, and you have a treat in front of you. But let me stick quickly to on the FPI front. First of all, while we've been celebrating the growth of the domestic investor over the last few years, that doesn't mean that our requirement for quality foreign savings to come into the country has diminished in any manner whatsoever. So while the numbers look great, if I remember the numbers correctly, we've seen about 12.5 lakh crores of domestic money coming into risk-oriented mutual fund schemes alone over the last 5 years plus. Compared to that, foreign investment flows through FPIs has been about 3.5 lakh crores. So the domestic component is more than 3.5 times what the foreign component is as far as investment flows are concerned. But that doesn't mean that our focus is shifting away from foreign flows. As I mentioned, our requirement for getting quality and drawing in foreign quality savings absolutely remains. Of course, with all this money being collected, both domestically and foreign, the need for us to ensure that there is supply of good quality paper and raising of good quality capital so that a sustainable cycle of capital formation ensues is very much there. But our focus is not on diminishing any of these flows at all. We still want to grow that. So at the Securities Exchange Board of India, one objective which is very, very close to our heart is ensuring continued ease of doing business for foreign portfolio investors, even as we ensure that we take all adequate measures as required to ensure compliance with our regulations, including disclosure requirements when required. Okay? And it's a topic very, very close to us. In fact, I can tell you that the chairperson of SEBI herself and I have had several review meetings on the score to try and put things into place. So I thought I'll take this opportunity to tell you about some of the stuff that we've already done and some of the stuff that we have on the anvil when it comes to this foreign portfolio investments landscape. First of all, we've put together in the SEBI what we call our FPI cell. So we've got officers who are dedicated only
Pradesh, valued at almost rupees 7,600. So these can be triggers for GMR Power going forward.
Got that. Sudeep, thoughts on any of these? The names, GMR Power or Aadhaar Housing?
Well, Prashant, Aadhaar definitely is worth looking at. This is an affordable housing segment. And of course, with Bajaj Housing Finance IPO around the corner, there was expected to be excitement around pretty much all the housing finance companies. But Aadhaar is different and it definitely merits attention. As far as GMR Power, it has been also in our list quite some time. I think they have cleaned up the balance sheet. To my mind, that's the most important thing. Of course, they have the power assets, they have the road assets, and these do augur well for the long term. And consolidation at some point of time with GMR Energy definitely will be in the cards. So all said and done, from a long-term investment point of view, GMR Power also does look good.
Okay, all right. Media exclusive. And there's potential relief for Infosys, which has been battling the 30,000 crore rupee GST notice. We learned from sources that the council is likely to clarify on this particular tax demand. For FMCG companies as well, there could be some relief on taxes which are imposed on snacks. Timsy, my colleague, is joining in with more details. Timsy, take it away.
Well, as you rightly said, the upcoming GST Council meeting, which is slated to meet on 9th of September, it is likely to consider provisions to give relief to Infosys. Remember, Infosys recently had got a pre-show cause notice from DGGI worth 32,000 crore rupees. After giving explanations, DGGI actually waived the first-year demand worth 2,000 crore rupees approximately for FY18. But yes, for the remaining period, that is between FY19 till FY23, 30,000 crore rupees worth of demand still stands, and Infosys has been saying that they want to come back seeking more time to DGGI on this. I'm learning that sources are saying that there could be a potential relief. Apart from that, an upcoming council meeting is also going to give relief and consider provisions for data hosting players such as Amazon, Google, Meta, etc. Council is likely to clarify on issues pertaining to service providers of software, cloud computing, data hosting, etc. There could be a possible clarity via circulars on treatment of place of supply, what should be treated as export of services in this case, GST rate treatment when recipient is abroad, and all of this is likely to be there in the detailed circulars. Apart from that, as you mentioned, FMCG companies are also likely to get a relief in the upcoming GST Council meeting. Council-nominated Fitment Committee is likely to have recommended for the Council's deliberations that when it comes to snacks such as fryams, etc., which are prepared via extrusion process, there the rate should be charged as 12%, but prospectively. In the past, that rate will be 18%. Remember, currently the rate that is levied on snacks such as bhujia, namkeen, etc., that is 12%, but on the snacks which are prepared via extrusion process such as fryams, etc., where we see PepsiCo has a product called Cheetos, Tuyam. Then there are many other snacks which are sold by ITC, Haldirams, etc. There were GST authorities who had sent notices to these companies seeking 18% GST, and that stands for the past liability. But for future, this will be clarified, and they will get parity as par with Namkeen. Back to you.
Okay, all right, Timsy, definitely snacks are serious business, and that while, we might talk about the taste, I think the tax is what has been playing on companies' minds. So it'll be really interesting to note what is the approach the GST Council takes. Thank you very much for that story as well. We'll take a break, come back on the other side, and we'll, of course, be in the last leg. We'll talk about the top corporate voices that we interacted with today and get you the top events to watch tomorrow.
Okay, welcome back. This is Markets Forward. Let's get you a sampling of the corporates that we had on the program today from the morning. So Keynes Technology is the first one that we're going to get to you. The company's received government approval to set up a semiconductor assembly, testing and packaging unit in Gujarat. The project will involve a capital investment of 3,300 crores and peak revenues once this is up and running and it's 100% utilized. I mean, the peak revenue would be 4,000 crores, according to the Keynes management. And the companies told us that they expect margins from this business to be sort of better than what they are making right now, which is around in the 50-odd% range, which should boost their overall margin profile going forward.
We also caught up with PNB Housing. The management sees net interest margins at 3.5% for the next 3 quarters. The management also adds that the company is aiming for the retail book to grow to 1 lakh crore rupees by FY27. So retail is the big focus for PNB Housing. They're expecting, of course, better benefits to accrue from the PMAY Yojana, the second one that has been announced just recently.
Okay, well, Bajaj Auto was the other one that we had in the program. They told us that they've sold 5,000 units of the Freedom 125 CNG bike, which was sort of unveiled recently. They're expecting this number to double next month. And they said that they have orders for 12 to 13,000 of these bikes, which have with the bookings and payment, which has already sort of come through and delivery is pending. They added that they've covered 33% of what they call the addressable market for these bikes, which will go up to 80% coverage soon.
Premier Energies made a strong debut on the bourses today, with shares almost doubling from the issue price. The management sees revenue doubling in the current year, that's FY25, versus the last financial year on the back of capacity expansion. The company also says that the order book stands at 5,900 crore rupees and the pipeline ahead is looking quite strong, with bids to the tune of 4,000 crores. The company is planning to improve its margins going ahead. Okay, so that was all the corporate commentary that we gathered today. Before we wrap, let's bring you the key events to watch. Tomorrow, Vamakshi is standing by with the details. Vamakshi, over to you.
Well, absolutely. When we look at tomorrow, it's going to be an eventful day. Let me first start off with the economic cues to track. First up, India will be reporting the services PMI data. Apart from that, US trade balance data is expected to come through tomorrow, and UK will be reporting composite as well as services PMI data. The European Union's PPI data for the month of July is also expected to come through tomorrow. But apart from that, there's a lot of stocks to watch out for. Segachi Industries and KEI Industries will be in focus. AGM is scheduled tomorrow for both of these counters. TCI, it happens to be the ex-buyback date for this company, so watch out for that. And Adani Enterprises will also be in focus, and that is because the company will be launching 800 crore NCD issue. Apart from that, Ecos Mobility will be another stock that we will be watching out for, and that is because it is expected to make its debut on the bourses tomorrow, and remember that it was subscribed nearly 64 times. Apart from that, Gala Precision Engineering IPO, the subscription closes for this one tomorrow, and Bazaar Style Retail IPO, the IPO allotment will be finalized tomorrow. So, of course, there's a lot to watch out for in the trading session tomorrow.
All right, Vimakshi, thank you very much for that. So that's a bunch of things which will be in focus as we return. Well, it's a wrap on this edition of Markets Forward from all of us here. Goodbye. Thanks for watching. Programming continues with news and updates in just a bit.